I think lots of people dialing in. We've got a very busy registration numbers this morning, so it's a very topical conversation, which I'm sure none of you are surprised about. And we're excited to welcome Rob and Steve from VAM this morning. Rob's one of their US managers, and he's going to be talking about a very busy gentleman at the moment, Mr. Donald Trump, and unless you've been in a cave somewhere for the last few months, then you'll be aware that we are seeing the emergence of Trump 2.0, and he's been an extremely busy boy so far, with lots and lots of activity and lots of discussion about places he wants to sort of take back and reclaim. Lots and lots of topic about tariffs, which I think Rob's going to touch upon today, and everything in between. So looking forward to today's presentation, which Rob's going to crack on with in a moment. So various parts, what he's going to talk about is, again, as I say, is tariffs and taxes, and really focusing a bit more on the sort of business element and the pro-business element to Trump, and where potential opportunities would arise from some of the activities that he said he's going to undertake and has actually already started undertaking. So at the bottom, you'll see there's a Q&A, and I'm sure there'll be lots of questions from the slides this morning. So if you have any questions at all, then please use the Q&A button that's at the bottom of the screen and submit them as the presentation goes through. And then we're going to have about 10 minutes of Q&A at the end. Anyone that's dialed in this morning, obviously you can watch it live, but we will also send you the slides and a copy of the recording, and anyone they'll be able to receive the recording afterwards as well. So as I say, Q&A button at the bottom. Rob's going to go through the slides. Any questions as we go through, please feel free to drop a message on there, and we'll try and respond at the end of the session. But what I'm going to do now is going to actually hand over to Steve, and Steve is very familiar to most of you, I'm sure. So Steve's VAM, and Steve's going to do a bit of an overview of VAM and then hand over to Rob. So without further ado, I'll hand you over to Steve and to Rob. Enjoy today's presentation. Thank you.
Thank you, Linda. Good morning, everybody. Just quickly, first, a huge thank you to Linda and to Steve for the opportunity this morning. It's massively appreciated. Quick overview of VAM funds, first of all, before I hand over to Rob. VAM funds are part of the Alpsy group of companies. And at VAM, we partner with highly specialist investment houses to manage the suite of our Luxembourg funds. Atomus and WTW run the 3 VAM multi-asset funds from London, and Driehaus Capital Management manage the VAM US Small Cap Fund and the VAM US Mid Cap Fund. And Driehaus have been partnered with VAM since we started in 2001, with over 20 billion assets under management. And I'm delighted today to be joined by Rob Gordon. Rob Gordon is a director of VAM Funds based over in Boston in the US. He's the ex-CEO of Driehaus Capital Management, where he piloted the firm for over a decade. So Rob's going to share his insights and the opportunities for the investor in the US. Over to you, Rob.
Thanks, Steve. We can move to the first slide. Yeah, and good morning or good afternoon, good evening, whatever time zone you happen to be in. And thanks, Linda and Steve. So the title of this presentation is Trump 2.0, but if you really think about the last 4 years, it's kind of an extension of Trump 1.0, right? Because he's never really left. He's had extensive influence, certainly at least on his party, the Republican Party, which is really now the MAGA party, ever since he left office. So his influence has been felt. And now, of course, that he's back in the chair, he has a great deal of influence on what's happening. And as has already been mentioned, he's been quite busy for his first couple of weeks in office. So we'll talk about the implications of that. We'll start with this slide, which I essentially use as my crystal ball to try and look at the headwinds and tailwinds affecting the markets, certainly the global markets, but in particular the U.S. markets and different asset classes and market caps within the U.S. market. And today, you hear that most of my comments are going to be biased around U.S. small cap equities, as I believe that's where some of the greatest opportunities. I'm still very constructive on the equity markets. For those of you who have listened to me before, if it sounds like there's a little bit of hedge in my voice, it's because we're certainly equities are not cheap, and as we've already mentioned, there's a lot of drama, a lot of uncertainty, and when prices are high and there's uncertainty, at least in the short term, that we get volatility. However, on a longer term basis, I'm still very constructive on the U.S. equity markets, and we'll talk about why. So let's just start by running through quickly what some of these macro variables are. And for usually macro is something that has a higher degree of certainty to it because you understand what the direction is, whether it's interest rates or the consumer or earnings, et cetera. But there tends to be a little more uncertainty in these markets, and a lot of that's been caused by Mr. Trump that we'll speak about. But just to run through quickly some of these variables. The Fed and where it's headed with interest rates, of course, is an enormous driver for the equity markets. And we really thought we were going to head into 2025 probably several months ago, where we were going to have this nice smooth path of declining interest rates, which the market was looking forward to, maybe 6 rate cuts in 2025. But now we're seeing with the impact that Mr. Trump is having potentially impacting the inflationary outcome. And importantly, the U.S. economy is extremely strong, and that's really the primary driver to cause the Fed to pause. So now we've gone from very unlikely 6 cuts, maybe 2 cuts, maybe no cuts, and maybe even an increase in rates. And that's important to the market, in particular for small caps, because small companies just don't have the balance sheet strength, generally speaking, to finance their operations. They need to go to the markets. And if interest rates are high, then that can be a headwind on earnings. But over the long term, I believe that interest rates will come down. It's just not going to be the straight line that we saw. So for now, it's kind of a mixed bag. Every time Chair Powell opens his mouth, their markets are going to be subject to volatility. And of course, there's the Trump factor here, which is him putting pressure on Chair Powell to try and reduce rates. Chair Powell will not succumb to that pressure. I remember the last time, at least in history, I wasn't around then, but the last time that a president influenced the direction of interest rates, and that was President Nixon forcing Arthur Burns to lower interest rates at a time when Nixon was trying to get reelected and improve the economy. And we all know what happened then. Inflation took off, and Paul Volcker inherited the Fed chair and ended up raising interest rates to close to 20%. The real interesting thing will be when Powell's term expires at the end of 2025, and Trump appoints a new Fed chair in 2026 that no doubt will be a fan of cutting interest rates. So long-term trend on interest rates will be down. Short-term, there's some volatility there. And of course, we talked about inflation, the second line down here. Inflation was trending downward. It's kind of flattened now at that 3% level. And again, it's because we have an extremely strong economy. So that's the glass half full, is that inflation continues to be stubborn because the direction of the U.S. economy continues to be very, very positive. A real tailwind for equities and small caps in particular is what's happening with U.S. employment. And I'll lump together the next 2 lines, the unemployment rate and U.S. consumer spending. This is probably one of the most important factors that drives the U.S. markets, because the U.S. consumer is roughly 70% of the U.S. economy. And when you have unemployment at these really stubborn rates of around 4%, which is full employment by any measure, usually full employment somewhere between 4 and 6%. So we're kind of stuck at that 4% level. And with that comes the consumer spending. And again, the consumers are spending. There are natural shifts that take place between goods and services. The U.S. consumer is extremely resilient and shifts back and forth. But with these kind of employment numbers and U.S. consumer spending, that's a real driver and an enormous tailwind for the U.S. equity markets. And with that, of course, follows the next line down, which is earnings. If the consumer is spending, that's driving revenue, which drives earnings. And the earnings outlook, we'll see what happens with the coming quarter here. But the guidance that we got at the end of 2024 for U.S. companies of all sizes, in particular for small caps, was extremely, extremely positive. And earnings over time is the primary driver of the equity markets anywhere, not just in the U.S. And if the earnings guidance is strong and it turns out to play out that way in 2025, that'll be an enormous tailwind for the U.S. equity markets. Geopolitical conflict resolutions, we'll spend a little bit more time on that as it relates to President Trump. There's always a fire somewhere, but maybe the fireplace flues are starting to open up a bit, so maybe a little less smoke filling the room and a little less of an impact on the equity markets there. So with that now, let's dive into President Trump's policies. Just before I start talking about his individual policies, I like to throw this slide up because, yes, we're going to talk about Trump today and certainly the impact of his various executive orders and policies and whatnot. But I like to show this to investors because what it tells you is that as long as the capitalist system of the U.S. economy continues to operate as it has efficiently and effectively, and as long as companies are free to operate and generate earnings, it doesn't matter who's in office and whether it's a Democrat or a Republican, left-leaning, right-leaning, center. The equity markets have done well over time. So certainly Trump can have an impact over the short term, but long term, the U.S. Open market, free market economy is what ultimately drives the markets. Okay, so now let's move into Trump world, and what I'm going to try and focus on, I'm going to stay away from sort of all the soft skills that sometimes Mr. Trump is accused of. So I'm going to stay away from things like his convictions as a felon and accusations of narcissism and fascism and anti-environmentalism and trampling on human rights. All that stuff is interesting, and the media loves to feed off that on a daily basis. But since we're talking about the markets here, what I'm really going to focus on is the pro-business aspect, and there probably hasn't been a president this pro-business in sort of, I would say, even 20th, 21st century history. He is a businessman first and foremost, and that's guiding the majority of his agenda, which is an enormous tailwind for the equity markets. So let's just run through these quickly. Taxes. Taxes are one of the biggest depressors of corporate profits, if you will, because you're paying taxes out of profits earned. And for small companies in particular, that's a real burden because larger companies are able to offshore a lot of their income or significant percentage of their income. I mean, let's take the S&P 500. 40% of their earnings are outside of the U.S. Small companies typically are saddled with the full ride when it comes to taxes. And Trump has made a lot of promises on taxes. He has, during his campaign, he said promised no taxes on tips, no taxes on Social Security, no taxes on overtime, no taxes on first responders, meaning firefighters, police, active members of the military. Probably an overpromise because that would take like 20 million people out of 300 some million population in the U.S. out of the tax rolls, and probably, by some accounts, as much as $10 trillion in revenue problems that would create. That aside, there will be reductions in personal income taxes, which will continue to fuel consumer spending, which, as I mentioned, is a critical component. It's the majority of the U.S. economy. And there will also be meaningful reductions in corporate taxes. And again, it's probably the most benefited recipients of that will be smaller companies, small and mid-size U.S. companies. So this will drop right to the bottom line. improve profits, and then, of course, the impact that that'll have on driving stock prices. Lots of conversations about tariffs, and primarily, the biggest concern around tariffs is that of, will it be inflationary? And I think tariffs will probably be, and this is sort of the popular opinion, but we're starting to see it unfold this way, more bark than bite, right? Remember Trump's best-selling book before he was president. The title was The Art of the Deal. And that's what Trump is all about. He's all about leverage. He's all about making deals. And he believes that his objective is not to cripple world trade. I mean, certainly he'd like to onshore or reshore as much manufacturing to the U.S. as he can, but he also recognizes that tariffs can be debilitating, not just to the U.S. economy, but the global economy. So he's going to use this. He's going to initially use it as a leverage tool. And we saw that with Colombia this week, right? And we'll see how that translates. He's already changing the rules, changing the numbers now. China, he's talking about 10%. He was talking about 25% or 50% before. So this is a moving target, and hopefully it is, again, more bark than bite, and really a negotiating tool. And we're seeing evidence that a lot of countries are willing to come to the table quickly and cut that ever-present deal that Trump is looking for. Global agenda. There's been lots of noise about that lately. So I think when the U.S. takes over Greenland, Canada, the Panama Canal, the Gulf of Mexico, that will probably be an important tailwind for U.S. equities. It'll probably solve some of the supply chain problems and significantly improve access to natural resources at a lower cost. Okay, so I'm just trying to see how many of you are awake there. That was somewhat of a joke. I don't think he'll take over Canada. But anyway, all that aside, his agenda as it relates to global affairs will probably be more noise than anything else. I mean, certainly pulling out of the climate accords, the trade deals that he'll cut, but probably not have a significant impact other than short-term volatility on the equity markets. I do think, on a positive note, if things calm down in the Middle East and in Eastern Europe, that'll have a net positive impact on the U.S. equity markets. U.S. regulations. This is a big deal. This is a real regulations are either a meaningful headwind or tailwind for the U.S. equity markets, because companies get buried in regulations, in particular smaller companies. It's a huge burden for them, time-wise, cost-wise, even more so than larger companies because of the extensive resources that smaller companies have to commit. So a reduction in regulations, whether it's environmental regulations or the time that it takes to get a drug through the Food and Drug Administration, can have a significant impact, time to market for new products, reducing costs, and have a direct impact on profitability. So I would say on this page, new tax law and reduction in regulations can be a very meaningful impact on profitability for U.S. companies, and in particular, smaller companies. So real tailwinds there. Next slide, if we can. Okay, climate policy, that falls under regulation. This notion of drill, baby, drill. The oil companies will be the first to say, we don't need more oil capacity in the U.S. The U.S. is already a net exporter of oil. We don't need more oil. But what climate policy will do for energy companies of all types is improve profitability as climate action and environmental regulations become deregulated. And Trump has even talked about eliminating the Environmental Protection Agency. Immigration is another one of those bugaboos that's talked about on a daily basis. Here, I would say, from a market standpoint, putting aside the human drama and human tragedy that can come out of this, and let's keep in mind that Obama was considered the deporter in chief when he was president. He actually deported twice as many illegal immigrants as Obama did, as Trump did during his first term. But the real issue here will be that if deportation of illegal immigrants becomes excessive, what does that do to labor costs? But here again, I think like tariffs, Trump's no dummy. He understands the potential impact that deportation can have on key areas like the U.S. construction industry, agriculture, and the travel and leisure industry. So I think there'll be meaningful numbers, but I think it's probably going to be more headline impact than really impact on business. Again, that's just my opinion. And the last one is just political culture drama. Again, not a sizable impact. So I think when you think about Trump as a pro-business guy, cutting out all the drama, all the headline stuff, all the personality traits, when you really focus on things like deregulation and taxes, he's going to create some real opportunities for profitability, corporate efficiency, time to market for new products. And those are all both in the short and long term, real tailwinds for the U.S. equity markets and small caps in particular. Okay. So why U.S. small caps? You've heard me mention that a couple of times. We're at this really interesting period in market history where small caps on a relative price to earnings basis are trading at a significant discount to large caps. If you were to look at the PE ratio on the S&P today, well, certainly it's been bouncing around lately. It's sort of in the mid to high 20s. Small caps, somewhere around the same, high 20s, low 30s. If you were to look back at history in recent years, you would see the price earnings ratio on small caps to be 40s, 50s, even 60s. And of course, on some of the high growth stocks, even higher. So we have this dislocation. Now, why is this sort of relative cheapness exist small to large? And the answer is really pretty straightforward. It hasn't been an earnings problem because small cap earnings growth has exceeded that of mid caps and large caps. So the real answer for that gets to how Wall Street, how street research, those who do their research on equities, U.S. equities, how they make money. And the way they make money is order flow, is volume. And the volume has been in the large caps, right? It's the Mag 7, where each of the Mag 7 has a market cap that's somewhere around a trillion plus. And if you look at the Mag 7, it's 4 times, just the Mag 7, 4 times the entire market cap of the Russell 2000. And so there hasn't been a lot of attention paid to small caps by Wall Street because simply the volume's not there to make money. The volume of margin lending, payment for order flow, they're more capacity constrained. So they're getting less attention. And with that, you haven't had the rise in prices. So you had the rise in earnings, but without the rise in prices. And we believe that's starting to shift now, where more attention is being paid to small caps because of their relative cheapness and their earnings power. And that's really the core to the Driehaus investment philosophy, is looking for that inflection point where earnings are accelerating faster than price. So that's why we believe, obviously there's going to be near-term volatility with all the noise and drama we just talked about. But over time, on a relative basis, the relative cheapness of small caps to large caps makes them a very interesting opportunity for an investor's portfolio. Okay. Steve talked a little bit about Driehaus, and Driehaus is the small cap manager for the VAM small cap growth fund. And as Steve mentioned, for a little over a decade, I was the CEO of Driehaus, an amazing boutique firm in Chicago, Illinois. They've had the same investment approach now for over 40 years. And the headline for how they manage money, it's really active management of active stocks. It's the antithesis of what you would see in a value manager. Value equity manager, not to disparage value, it's a good investment strategy, but value managers find companies that they like fundamentally or technically, quantitatively, whatever their base style happens to be. And they say, we're going to sit on it. We're going to hold it because we believe in time it'll be recognized by the market. Driehaus takes the opposite approach, active management of active stocks, there needs to be evidence of accelerating earnings growth, and that price is beginning to follow. So every stock in the portfolio has to be working. And that's the cornerstone of how Driehaus manages money. They're looking for that inflection point where earnings are accelerating and price is starting to follow. And that has to be the case for every stock in the portfolio. Another thing that makes the firm somewhat unique is that as a boutique firm, about 20 billion in assets under management, about 100 people, that it's independent. There are very few managers in the US, particularly in the boutique space, that are independently owned and operated. Most are part of some larger financial services company that puts a lot of pressure on profitability, where investment results come second. And at Driehaus, investment results come first. They're not owned by some larger insurance company or bank or other money manager. They're all about investment results, and that creates real alignment of interest. Okay, we can go to the next slide. This continues sort of the competitive edge that the firm has, which is, hey, what is it all about when it comes to active management? It's the team that's managing the money. And the two photos that you see at the top of the slide there, Jeff James and Mike Buck, these guys have been managing the small cap strategies at Driehaus for well over 2 decades. And this is all they do. They're not managing large cap portfolios. They're not managing ex-US small cap. They're managing US small cap. And the team underneath them is also dedicated to these strategies. Some firms employ a pooled approach to analysts, where the analysts are a pooled resource to all the investment strategies in the firm. These analysts are dedicated to the small cap strategies. They work only for Jeff and Mike. When you look sometimes at the history of a fund, you'll see over time different managers coming in and out, and there's always the story of this manager was running it for this period, and then it was taken over by that manager. These guys have been running the fund since inception, and so when you look at the investment results, the exceptional investment results of the VAM Small Cap Growth Fund, it's these guys that have been at the helm. Another important aspect that you should look at when evaluating a portfolio management team is skin in the game. And I can tell you from personal knowledge that both Jeff and Mike have significant investment skin, 7-figure skin in the game. So they're coming in every day, not just to manage our money, as investors in the funds, but their own personal accounts as well. So that's a real testament to skin in the game, dedication, and focus. So an exceptional investment team, portfolio management team in place. Next slide. It's always interesting to take a quick look at the top holdings, because that speaks to how the fund is managed and the investment philosophy and process. Usually when one thinks of US small cap equities, they think it's a bunch of tech stocks, right? That it's really a NASDAQ portfolio. But what we see here is a very diversified portfolio of companies. Certainly a lot of technology exposure, but also healthcare, biotech, consumer stocks, industrials, materials. And then, of course, the other thing that's interesting as you look at this list of companies down the left-hand side is, I would beg to say, probably most on the call don't recognize these names. And that's wherein the opportunity lies. Usually you sit down with your client with an equity portfolio and they take some comfort in recognizing names in the portfolio, usually the Mag 7 right at the top of the list. This is a list of companies that are really demonstrating best of breed, best of class, accelerating earnings in their category. They're not household names, and therein lies the opportunity, right? Driehaus is really doing the work on what may be, at least to the marketplace, undiscovered companies with tremendous current earnings and earnings opportunity. And just to run through some of the names here, Crinetics, which is in therapies for endocrine diseases, Astera Labs, that would be an AI play, hardware for AI, switches. CyberArk, also another AI play. They're in the identity security business, which is a top AI risk. FTAI Aviation, which is in the aircraft engine business. Modine, another AI play. They're in the heat transfer business. We've all heard about the challenge with heat in any of the computing and the speed that's happening in the computing space and how to deal with the heat that's created. Glaukos is in glaucoma therapy business and healthcare. Sprouts in organic food stores. Natera is in DNA testing. Fresh Pet, I'm sure this is a global thing, not just a US thing, but our pets are eating better than we are. So that's a pet food company. And Semtech is another EI play in the semiconductor and algorithms for AI. So a really diversified portfolio. Fund weight, which is in the middle, again, this is top 10 holdings, and you can see that percent holdings are somewhere between, say, 160 and 200 basis points, 1.5% to 2%. And that's because this is a really diversified portfolio, around 100 names. You don't want to take excessive risk in any particular small cap name, because a negative surprise on earnings can cause a significant drawdown in terms of volatility. So having a really diversified portfolio with smaller weightings significantly reduces risk. The returns in the second to last column speak for themselves, exceptional returns. This is not a cherry-picked list. This is the top 10. And then, of course, the entry date, I mentioned active management of active stocks. You can see these are relatively new holdings in the portfolio. The portfolio is always being turned over, share turnover, name turnover, but every name needs to be working all the time. So that's a little bit on the portfolio. Next slide, of course, is the proof is in the pudding. And the first column is the performance of the index, the Lipper Global Small Cap Index. Over the life of the fund, respectable return of 488%. But then you move to the fund, the VAM US Small Cap Growth Fund, and you see 3 times the return of the index over that period. So absolutely exceptional results. Even during a period, as I mentioned earlier, where small caps aren't getting the attention they deserve by the markets, still exceptional returns over time. And again, keep in mind, this is the same team for decades that has been running this fund. Next slide. This last slide is just, we often get the question, okay, well, small caps, we understand the return potential with small caps. We've just heard the story, Rob, that you gave us on relative cheapness, but how do I use small cap in the context of my overall portfolio? Certainly, investing in small companies is not a core strategy. It's a satellite strategy to your larger cap equity and fixed income exposure. But what we modeled here was the idea that most balanced funds are underweight small caps, right? Most are dominated by large caps, in particular the Mag 7. So we just modeled a portfolio where we took a traditional balanced portfolio and added 10% VAM US small cap. And you can see the incremental return without adding any significant risk to the portfolio. Took the return from, let's see, roughly a 38% return on the balanced portfolio. If you added 10% of this VAM US small cap over the period, improved returns to about 50%. So a significant increase in alpha in return with only marginal increase in risk. And that's generally how we suggest that one thinks about adding small cap to the portfolio as a satellite position. 5 to 10% can add some meaningful alpha to the portfolio. So that's the presentation. Happy to take any questions. The summary is really Trump, putting aside whatever issues you have with him on his soft skills, on a hard skills basis. He is a businessman, and the policies that he's putting in place can be really important drivers for the equity markets overall, in particular small caps. You combine that with the relative cheapness that we see on good, solid earning small cap companies, and we believe that over time, investors will be rewarded in that space. So happy to take any questions, comments. Feel free to disagree with me as well on the points that we've just covered.
Thanks so much, Rob. Really, really interesting, and some really interesting facts. Your comment on how Obama had actually deported more people than Trump in his first go of presidency was quite interesting. And I saw another stat similar I think it was on Newsnight, where they said that Biden had actually given out more drilling contracts than Trump had in his first presidency as well. So a lot of what comes out in the media, actually, there's other elements to it that, I think the media likes to create that drama around him. So, it's quite interesting when you see some of the black and white facts.
Right. And Trump likes to create the drama because remember, he's a TV celebrity as well as a president. So this is all part of the show. But yes, like you say, you have to look at the numbers.
Through and ultimately, as your presentation is sort of is focused on that business side, so we have had a couple of questions, and obviously the timing of this webinar was interesting given the news yesterday, and we've had a few questions on that, as you would expect. So quite a few people's personal Nvidia holdings have taken a serious hit yesterday, and I think DeepSeek is now one of the most downloaded apps, and we've had some comments on that basis as well. What's your views on AI, and just looking at your portfolio holdings? Obviously, you touched upon those, and some of those small caps had sort of quite a big focus on AI. So what are your current views on that, given yesterday's news?
Sure. Well, I think it's very exciting for small caps because they are the benefactors of the rate of change that's happening in the AI place, because they're the ones that are providing so many of the inputs, whether it's hardware or algorithms. They're doing chip production. They're the suppliers to the larger companies. So whether they're exporting to China, to the larger companies in the AI space, or the NVIDIAs or the Microsofts through OpenAI, the small companies are the real winners as this evolves at the breakneck speed. You're going to see probably more breakage on the large cap end, especially with the elevated prices, as the pace of change picks up in AI. I think we're all familiar with the concept of how industries evolve over time, and new players come in and displace other players, or at least begin to level the playing field. In AI, just again, thinking about the whole concept of AI, it's about efficiency and speed. And so you're going to see disruption in the marketplace, particularly in the larger cap space, as sort of players dominate, other players come in and dilute their strength by competing with them. And competition is good because competition will create more opportunities. But we're going to see a lot of volatility, particularly in the larger cap AI space, as this industry evolves. And from my perspective, it's going to be the smaller cap companies that are going to be the real benefactors, because they're nimble and because they're suppliers to the larger cap companies, whoever happens to be dominating in the larger cap space. So I would not look at yesterday as a singular event, but rather stepping back, thinking about the speed of evolution or revolution that's going to happen in the AI space, and how quickly it's going to create winners and losers. And frankly, this is not so much a pitch on active management as it is the reality of it. It's going to be more disruptive to the performance of an index than it will be to, say, an actively managed portfolio, where you're paying an active manager to stay on top of the speed with which things move and trade in and out of the names that are the winners and exit the losers. So there's going to be plenty more of what we saw yesterday to come.
Yes, I can imagine, absolutely. And a couple of questions on that small cap. People are asking, is it too late to sort of dive into small cap? Is there still lots of opportunity from the sounds of what you just said? You guys obviously small cap house, believe in that quite strongly. So, is now the time for people to be sort of looking at small caps as that sort of space to fill?
Yeah. So my philosophy as it relates to equity investing is equity investing is not an event, right? It's a process. It's a perennial part of a investor's portfolio, certainly a perennial part of my portfolio. So it's not something that you measure in. It's not a trading strategy. It's not something that you measure in its outcomes in a matter of months or a year or even 2 years. It's a long-term part of an investment strategy. So as long as the earnings story remains intact, then there's opportunity for upside. I mean, Richard Driehaus used to use the phrase all the time, buy high and sell higher. And that theme of his was about as long as earnings continue to grow, and as long as the fundamentals around that, and I talked about some of those, like the interest rates are at reasonable levels, that taxes are at reasonable levels, and some of the policies that Trump is moving forward on, that can continue to create a positive backdrop for earnings. And as long as earnings are growing, as long as are accelerating, and again, this is where stock selection becomes very important. 40% of the Russell 2000 generate no earnings. So this is a place where there are always new small cap entrants in the marketplace. There's always exciting stories, new discoveries that are happening in the small cap space. So it's never a missed opportunity because it evolves so quickly. At the same time, you have to keep in mind that, like any equity investment, it's a long-term part of your portfolio.
There's quite a few questions, so we've got another sort of 5 or 10 minutes. So I'm going to try and get through as many as possible.
Sure.
And we've had a couple of questions on, we're sort of trying to avoid Trump personality per se, and obviously we're trying to focus more on business, but there has been, as you'd imagine, a couple of questions on his sort of narcissistic personality, which I think we can all agree on.
Right.
Could that lead to him making decisions that sort of flatter what he wants, or the narrative that he wants to sort of portray, which could then lead to sort of counterproductive or even destructive economic consequences for markets? So I guess the question there is really, can we ignore his personality and his sort of ego?
Yeah, and this is where we hope that remember the U.S. Well, as much as he fashions himself as a, dare I say the word, sort of dictator on a near-term basis, we have several branches of government in the U.S., and that includes Congress. And yes, Congress is dominated by Republican majorities, but they're very thin majorities. So when it comes to, Trump has issued a lot of executive orders. He can't issue executive orders when it comes to tax policy. He can't issue executive orders when it comes to a lot of regulation, because regulation is based around law. You have the Supreme Court that plays a role as well, and in areas like immigration, the Supreme Court gets to weigh in. So he can create lots of noise and make lots of statements, but at the end of the day, there are 2 other branches of government that can add a dose of reality and be a dampener on policies or statements that otherwise might be destructive. As a matter of fact, there was a meeting in Florida with the Republicans and Trump this week at one of his Doral resorts, talking about how we're going to make tax policy work, recognizing we're not going to be able to do everything, but we need to do the things that are going to make an impact. And the same will happen around other forms of legislation, deregulation. So I think, despite the fact that he would like to wear the mantle of king, we have checks and balances in government that I think, if he can stay focused, that'll be the real key. It's not so much the damage that he can cause as it is his ability to stay focused, so we can make sure that we're able to implement these pro-business policies that are on his agenda.
Yeah, absolutely. I think that focus is the key, isn't it? And sort of not getting carried away with the sideshows almost. And then we've got time for one more question. Again, we've had sort of a few similar, and it's around the regulatory changes under Trump. And could these create structural advantages for certain sectors, for example, like tech or energy or other sectors? And what would be your views on that?
Yeah, the exciting thing is deregulation will bleed across virtually every sector, because it reduces the need for manpower and cost, hopefully not destructive in terms of lack of oversight, But I mentioned healthcare as an example. Healthcare has been kind of a laggard sector in the marketplace. Deregulating, moving the FDA approval process along faster can bring new drugs to market faster, which is really important, particularly in the small cap healthcare space. But deregulation is going to be a strong tailwind across every industry because it massively reduces cost burdens, which drops immediately to profits, and of course, profits driving stock price. And it also spurs new product development, innovation, and time to market. So yeah, we're going to see it across tech. We're going to see it across energy. We're going to see it across healthcare, but virtually every industry is going to be a winner due to deregulation.
Yeah, I think it's a really good point, and it's been really interesting. I think I've tried to cover most of the themes of the questions. We did have quite a few. Thank you everyone for sending your questions over, and of course, if you do have any other questions, then if you want to reach out to Steve, and Steve can reach out to Rob, and I'm sure that the guys would be more than happy to answer any further questions that you might have.
Absolutely, yeah. Thank you, Linda.
Linda, thank you very much. Steve, thank you very much.
Thanks so much for the time. It's been extremely interesting, as we knew it would be. And everyone who's registered will receive a recording and also the slides. So look out for those in your inbox. We have our next webinar coming up at the end of February. That will be with Evelyn. More details to follow in our Pulse newsletter, which you'll be receiving in your inboxes shortly. But all that remains for me to do today is say thank you so much, Rob. Really interesting. Really appreciate your time. Thank you, Steve, as well. And thanks to the guys at BAM for supporting us. And thank you all for taking the time out to register and dial. It means a lot. We enjoy putting these webinars on. We're always looking for ideas for new content. So if you've got any ideas, please feel free to feedback to us or your ISMs. Have a great day, everyone. Thanks so much for your time. And thanks again, Rob.
Very good. All right. Thank you all. Bye-bye.